Welcome back, everybody, to the Informed Home Buyer Podcast. I'm your host, as always, Rich Curtis, and I have with me my co-host, Dave Miller. Morning, Dave.
Good morning, Rich. Thanks for having me.
Think we got it right. I think it actually is morning this time, but
Right.
close.
I always have to glance up and look at the clock to make sure we got the right time here.
So today we are going over FHA loans. We're going to give you a 2025 update on FHA loans, what you need to qualify for an FHA loan in terms of credit, debt to income ratio, all that good business, why FHA loans are advantageous, a couple of things you should know that are different and a little more costly than an FHA loan. And at the end, we're going to go over why an FHA loan might be your best on-ramp to home ownership in 2025 in a declining market. For those of you who have been on the ragged edge of affordability, who are watching the podcast, who are waiting for prices to come down because homes are just out of reach, as prices come down, this loan might be your best bet to be able to get in and take advantage of the price declines we see later in this year. That's what we're going to go over for you today so that you can get prepped and ready to take advantage of the opportunities that this market will present to us later this year and early next year as well, if things go like we think they're going. So I'm going to hand it over to Dave to tell us what is an FHA loan, Dave, and what do our buyers watching today need to do to qualify for one?
Yeah, Rich. So, FHA loan, and I don't have the exact dates. These have been around a long time, really designed the Federal Housing Administration to open opportunity for buyers in, with less maybe advantageous credit scores, less money down, really just to give an opportunity to buyers that didn't meet such stringent lending thresholds that used to exist in the past. And, between conventional and FHA, they've kind of blended a little bit where conventional has, maybe gotten a little bit easier in some areas to compete with FHA and vice versa. Typically the FHA loan is designed for someone that, maybe doesn't have as much money down. You can get away with as little as 3.5% down on an FHA loan and not an ideal credit score. And so people always say, what's the minimum credit score that I need for an FHA loan? Well, FHA loans are offered, all the way down into the low 500 credit scores. The chances of getting that is pretty minimal. There's some criteria like 9 out of 10 things need to come into play if your credit score is super low. So when below the 600 or 620 mark, typically for someone that is looking for an FHA loan, our ideal credit score is 620. Where when you're looking at a conventional loan, 680 and above, 700, and the other criteria to that delta between conventional and FHA loan is mortgage insurance and based on down payment. So FHA, independent of your credit score, has a fixed mortgage insurance. So any one loan you get that has less than 20% down is going to have mortgage insurance. And with conventional, the lower your credit score and the less money down, that mortgage insurance can become quite expensive and actually price you out versus an FHA loan where it's 0.55% with 3.5% down. I think if you put more than 3.5, if you put 5% down, it goes to 0.5. It's pretty nominal, but you could have a 620 credit score and your mortgage insurance on an FHA loan is the same if you have a 720 credit score.
And what might that be on? I know you don't have the exact numbers in front of you, but what might that be on, say, a conventional loan for PMI? PMI is just our jargon for private mortgage insurance, folks.
Yeah.
So on a conventional loan, if you had a 600, 620 credit score, what might you be paying in terms of private mortgage insurance there?
Yeah, that's good, Rich. I think typically that's going to be double or more than what you're going to pay on an FHA loan.
Gotcha.
And it's pretty significant. And also when you're getting the on the conventional loan with a lower credit score, the ability to qualify, it gets much tighter with less money down, higher loan to value, and then by the time you add in that private mortgage insurance, it gets quite expensive and a little bit more difficult to qualify.
What does that look like monthly? Like for someone on a conventional loan, private mortgage insurance ballpark monthly.
Monthly, you're talking 400 plus bucks. So, if I just did a quick little scenario, we usually use $500,000 purchase price as our baseline. So if you were to do a $500,000 purchase price and you were to put 3.5% down, and I'm just, for this scenario, using a 6.75 interest rate, you're looking at a total payment of 4175. So 3.5% down puts you a loan amount of 482,000. Another piece that's missing there is with FHA, you also have to do an upfront mortgage insurance premium, which is 1.75% of the purchase price. So a little over 5,000 on this loan amount.
That is
Um,
not monthly recurring, though. That is a one-time upfront fee that's paid as part of your closing costs,
that
correct?
is correct. And then that goes away once you sell, you lose that. Most folks will finance that in, can bring that 1.75% in. That's an option. If you want to reduce your loan amount, most folks finance that. And if you were to refinance down the road, you can, some of that portion, anytime you do a purchase or a refinance, you have that one time upfront mortgage insurance premium. But within what they call like a streamlined refinance, you still have some of that upfront MIP available to use as a credit towards your refinance loan.
Nice. Now, before we move on from this mortgage insurance, just to put a pin in this for folks, what this means. Dave and I were just offline doing a little math for our next episode, where we're actually going to present to you the difference between the savings on purchase price reduction versus the savings on interest rate reduction. And Dave, we were talking about $160 a month savings for 25,000 in purchase price reduction for that next episode. Now,
Yep.
a little bit of quick math means, if you're looking at $400 for upfront mortgage insurance, that's a $62,500 in purchase price that you lose, purchasing power that you lose just because of mortgage insurance on a conventional loan.
Yeah, yeah, and it's significant. And for the number 220 is the mortgage insurance on a $487,500 loan with FHA. So 220 versus probably double that with a lower credit score if you're going conventional.
So
Big difference.
the delta there between the two loan products could be the difference in $30,000 in purchasing power for you as a buyer. And that's one of the reasons, we're going to get to this later in the episode, but that's one of the reasons that in this declining market, for our buyers that have been on the ragged edge, you've been priced out, you're just watching and you're just waiting for any house to come down to a price you might be able to afford in this lifetime. And I know that's a lot of you, and I'm sorry, and I hate that that's the case, especially in our primary market of California. That's especially the case. Well, just choosing this loan gets you $30,000 extra in purchase power. So as you're watching prices decline over the rest of this year, waiting for your opportunity to get in, speaking to your trusted lender. If you're in our markets, talk to Dave. And that's, our market for Dave. Now, I only work the 5 counties here: Placer, Sacramento, Nevada, El Dorado, and Amador. But Dave can write loans, lucky him, in the entire state of California and the entire state of Nevada. If you're in his markets, call him. If not, call your trusted advisor, or we'll help hook you up with one in another state. But get pre-qualified. See if you qualify for the FHA loan. See what that adjust your buying power to, because this could be an on-ramp to earlier home ownership, or you might be looking at purchase prices that are, out of reach right now, but with an FHA loan, they would be in reach. So as the prices drop, they don't have to drop as far maybe for you to enter the marketplace if you're taking advantage of an FHA loan. So that mortgage insurance, we can't say enough about the difference that makes for people.
Right. And I think, Rich, one of the things we talked about is this perfect storm that's been brewing. It's coming. We're seeing, increased in the most recent podcast on inventory levels. We're seeing that increase in inventory. So if we were to rewind 3 months to 6 months ago, when it was a true seller's market and you had multiple buyers on a single property, if someone was writing an FHA loan versus a conventional loan, fair to say that typically agents are going to favor that conventional loan, even
Yes.
if it's slightly less than that FHA loan. Just historically, there was some negative connotations about some FHA loans, which they're really not. They're very similar. There's a couple criteria hurdles that you have to address with an FHA loan, in terms of, working utilities. The FHA appraiser is going to poke their head in the attic. They're going to turn on the utilities. They're going to make sure that the the range works and the HVAC system works, things like that, which in a conventional loan, they don't check everything.
Yeah.
But
Well,
I,
I think the biggest stigma has always been that the FHA buyer is broke. That's how the seller looks at it. So from a
yeah,
seller's perspective, they want cash because then there's no loan to scuttle the
yeah,
deal if it goes sideways. They want
right,
conventional, then FHA, then VA, then USDA. It kind of goes like that in terms of preference because of a lot of these old stigmas on the
right,
VA loan, which we talked about in our VA episode, which I hate, which no longer exists. The appraisal process isn't that bad.
right.
FHA, the idea used to be, well, that buyer's broke. They don't have enough skin in the game. I don't want to work with that buyer. Well, I mean, conventional people used to assume conventional putting 10 to 20% down. Then conventional dropped to 5% down. Well, FHA is 3.5%, conventional is 5%. Well, they're either both as wealthy or both as broke, depending on how you want to look at it with either loan. And now
Right.
conventional has dropped all the way down to what can you get now, Dave, on a
Well,
conventional as low as
3% or 100% financing with down payment assistance. So they
exactly.
are, so you really got to uncover what's going on. And if I was a seller, and one of the things about an FHA loan, and one of the, I think the biggest advantages, separate from credit score being low, is they allow for higher debt to income ratio.
Yes.
So with folks with, we talk about the five fundamentals of being prepared to buy a home. So if you're someone with stable and inclining income, getting into a home with an FHA loan and just putting as little as 3.5% down sometimes is ideal. And, you know, in any market, when I'm first interviewing a potential home buyer, everything's on the table. If you have perfect credit, you have a lot of money down, little money down. I always have the conversation. Let's look at both loan, all loan programs that you might qualify for. Are you a vet? No. Okay, let's get rid of the VA option. Do you
Yeah.
want to put 5, 10, 15, 20% down? How much do you have in reserves? How much is this going to affect your payment? Are there times where an FHA loan might be more advantageous versus a conventional loan? And I've had people come to me saying, yes, I want to get an FHA loan. What do I qualify for? And I really dig into it. And a conventional loan might make more sense for that buyer. I think the biggest criteria, besides back again to mortgage insurance, with a FHA loan, that mortgage insurance is perpetual for the life of the loan,
Yeah.
versus a conventional loan where, if you get 20+% equity at some point in time, that mortgage insurance automatically falls off. And there's some other steps where you can get rid of mortgage insurance earlier than at that point in time.
Yeah.
So that's kind of key there. But for someone that's a first time home buyer, the average loan does not last. I think right now we're in a little anomaly right now because of the low interest rates we had from the pandemic. But historically, loans are 5 to 7 years is the max anyone has, any 30-year mortgage.
Yeah, I think
Um,
that's extended to 10 now because of lock-in effect, which is still 1/3 of the life cycle of the loan.
Right. And so one of the things we look at, and I'm always cautious, you're buying today to do an FHA loan, two ways to get out of that. Obviously you could refinance down the road, refinance to conventional once you have some equity. But there's no guarantee when that equity is going to come, so you can be, is that with a combination of maybe you come into some money and you want to put more money down on your loan and you want to refinance to conventional down the road. Maybe the values go up over that 5 to 7 years in that window, where now you have enough equity. Or with a nice thing with an FHA loan is you could do that streamline refinance, really regardless of the value. And that's another
Yeah.
benefit of the FHA loan. So if
Well, and
rates
you
come
and you
down,
you can
yep,
always, if you gain a bunch of equity on your FHA loan, you can always refi out to a conventional loan if you now
correct.
qualify. Because if you've had a mortgage for the last 7 years and you've been making your payments on time, your credit score is going to have improved, and you may now qualify for the conventional loan. You can get rid of the mortgage insurance that way as well down the road.
Yep, that is 100% correct. And so, right now as a buyer that's kind of been waiting for interest rates to come down, we don't see that really happen in the near future, right? Like in terms of anything significant. So if you start seeing values come down, we just did that math there. You are competitive now as an FHA buyer with the amount of inventory that's out there. And if you write an offer, you're conventional, from a seller's perspective, beggars can't be choosers. And so you have an FHA offer in hand versus no offers in the other hand. That FHA offer now is pretty compelling.
Yeah, and I think an important piece of that too is the agent and the lender you're working with, the team you're working with, providing some education to that listing agent. So sometimes we have listing agents who've been doing it a long time. They just carry these stigmas forward, like we talked about. Or sometimes we have younger agents being trained by these older agents that just absorb these stigmas. And so, as we said, now conventional loan you get 3% down, FHA you can get 3.5% down. So your conventional buyer might have less skin in the game, less money in the game, and the FHA appraisal process isn't nearly as onerous as it used to be. And there are fully capitalized, buyers utilizing FHA loans for certain reasons that make sense to them. So now it takes your team getting on the phone. Like I said, if you're in our market, we'd love you to give us a shot and we'll help you out. But if you're not, have this conversation with your agent. Say, hey, I'm submitting with an FHA loan. I want you and the lender to call that agent when you submit my offer and make sure you let them know my financial position. Let them know that, sure, I'm only putting 3.5% down, but I have reserves in the bank. I'm a well-qualified buyer. I've gone all the way through. This is another way to make your FHA loan stand out. I've gone all the way through the pre-qualification process. I am fully approved, property address to be determined. I've been through underwriting. So now, this letter of my FHA loan is more secure than your pre-approval letter on a conventional loan where the lender said, "Oh yeah, oh you make that much? Your credit score is that much? Sure, as long as everything you said is true, we'll give you the loan, right?" So having a team, and that's something Dave and I do on every one, is we never submit blind offers. We call the agent. I prep them on who you are, on the parts of the offer, on your qualification as a buyer, and then the sort of icing on the cake that they don't expect is having Dave call them and do the same thing. So make sure you require this of your team.
Yeah, and, and a lot of times when I'm talking to that listing agent, sharing the pre-qualifications of the buyers, that, well, why are they going FHA versus conventional? They want to know why.
Yeah.
And I've often had times, and maybe folks that are watching this, where you qualify conventional, but FHA just pencils way better when we're talking about the mortgage insurance. The other piece that I didn't mention earlier, which has significant impact, is I always look at blended payments in terms of, okay, what's your payment conventional with mortgage insurance versus FHA with mortgage insurance. FHA is also typically has a lower interest rate than conventional. So if on average you're looking at, we'll just say a quarter point lower in interest rate, that's another $80. So even though your mortgage insurance on FHA is 220, just the principal and interest alone is $80 cheaper than that conventional. So not only are you paying an extra $200 in mortgage insurance on that conventional loan, you're paying another $80 in principal and on the interest payment based on the interest rate. You're talking $300 delta. How long does
Yeah.
it take to recapture that? And so,
Well,
the,
how much more purchase price? Again,
yes,
$300 delta, you're looking at what, 40,000, 38, $40,000 in additional purchase power. And if you're in the middle of a price bracket, maybe that doesn't matter. But when you're at the upper edge of a price bracket, right, the difference between a $480,000 house and a $510,000 house in our market can be significant, right? The difference between a $500 and a $540,000 house can be
right,
significant. So then that's why even a good credit, because with good credit, they're going to even get a little bit of a break on the MI, on
yeah,
FHA. So even with good credit and a well-capitalized buyer, some of
yeah.
them are just choosing FHA because it makes more sense.
Right. And we've had this discussion a lot, Rich, and someone comes to you, they're pre-approved, they're underwritten, pre-approved, and their comfort level to your scenario is 480. 6 months ago, you wouldn't have taken them to look at a 520 house if their comfort level was was 480. But now with the market, and you can sense, hey, this individual, there's a lot of houses for sale in this particular neighborhood. We might be able to get this property down by 20, $30,000. Let's go take a look. Maybe you submit an offer. You preface like, hey, this is a stretch, but that now kind of comes back into play even with an FHA offer.
Yeah, all these things will be coming back to the table, asking for price reductions, asking for credits to closing costs, those
Mhm.
sorts of things. So, just to recap this section for you, the main benefits of the FHA loan: you can qualify with a lower interest rate. You have lower private mortgage insurance. You can put a lesser amount down. And also, the one I don't think we hit yet, Dave, is the debt to income ratio
Yes.
being a little looser for people. So kind of give people a primer on what debt to income ratio is and kind of compare the differences between conventional and FHA.
Right.
Because if you have a lot of installment debt and your debt to income ratio is a little bit higher, that might blow you out of a conventional loan, right? But FHA
Right.
might be an option.
Yeah, and so for mortgage loans, we look at two ratios, your top ratio and your bottom ratio. Your top ratio being just your housing expense, which includes everything we've talked about: principal, interest, taxes, insurance, mortgage insurance, versus your income. So, that may look like something, and I'll just throw a number out there. Maybe that is 30% or 25%. But then if you have a lot of other debt, and we look at the bottom ratio, which is a combination of your other revolving debt, installment debt, student loans, maybe alimony, child support,
Credit
a number of
cards.
things, auto loans, anything that you may have will affect your bottom ratio. And
Yeah.
so a lot of folks are in a position where there's light at the end of the tunnel on that revolving debt, but it's pricing them out of a conventional loan. And so, that might put you at 50% or 48%, where a conventional loan, especially with lower credit, and then the MI is going to be really high. Well, now we look at an FHA loan and we see those approve up to 55% debt to income ratio. And we talk about them as being compensating factors. If you're someone, and I would never be a fan of saying, hey, your debt to income is only 55%. That doesn't leave much left over at the end of the day. But if there's light at the end of the tunnel, you have inclining income, you have guaranteed or percentage pay raises that are coming. If you have this debt, maybe you have an auto loan that you have 16 months left on. And some folks, that's significant. That's $600 or $700 a month. Can you tighten it up for a year and a half until that auto loan's paid off? Can you student loans? So, whatever that may look like, can you get a roommate for that amount of time till you are in a better position? So we always look at all of that stuff, but you certainly would want to look at that FHA loan with higher debt to income ratio if there's light at the end of the tunnel within a reasonable amount of time, that bottom ratio will come down, so you're not living, paycheck to paycheck just to make your mortgage.
Yeah. And so let's, we don't give financial advice. None of this is financial advice. You got to call your trusted professional, us in our market, someone else in another market, and get a customized plan for you. But let's talk through just a couple of avatars, the type of buyers that come to us that generally fall into FHA loans. One of the first ones that comes to mind for me are recent college graduates that have just gotten picked up for their first jobs, right? So
Yes.
they may have higher installment debt coming out of school, or they were young and silly, and they screwed up on managing their finances, making payments, so their credit might be a little crappy for now. They're just really starting to do some adulting in their life, so they're not exactly where they want to be, but they have the income and the
Mhm.
wherewithal to make a house payment, and they want to get into the real estate game so that they can start building equity. That's sort of the first avatar, the young college grads, young married couples that I think of when it comes to FHA loans.
Yeah, I think you're spot on there. And also folks that got into some recent financial troubles, job changes, debt mounted, credit got a little banged up. You,
Had
you
a
know,
health
that
crisis.
yeah, yeah, whatever it might be. And now that's kind of, they're in the recovery mode for that. But it oftentimes takes, a significant amount of time. And it's also to your scenario where, someone maybe recent out of college or recent into a trade, maybe you were in a particular trade, and you were an apprentice before you become a journeyman, and your income goes way up, and you were spending every dollar you made, and maybe not paying your credit card bills on time, all of that stuff. Those are the folks that FHA loan often makes sense for as well.
Yeah. So we've gone over the primary advantages. Now, again, the reason we are talking about FHA, we talk about it every year. We talk about it every few months because it's such a valuable program and it makes a lot of sense for a lot of you watching. But right now, in terms of this moment in time, if you watched our last podcast, it's titled, I think, "Is Now the Worst Time to Buy a
Mhm.
House?" And the spoiler alert, the concept there is that no, for some people this is going to be maybe the best time in the last decade for them to buy a house, but certain people should be thinking about it, certain people shouldn't be thinking about it. And for you, on the ragged edge of affordability, just trying to make it happen, first time buyer types, right in this second might not be the best time to buy a house. But as we see price declines over the rest of this year and early next year, this might be your moment. This might be your opportunity. And the FHA loan, with its flexibility on credit score and debt to income ratios, with its lower interest rates and lower PMI, can buy you. All that adds up to a lot more buying power. And this can be your on ramp to actually be taking advantage of the opportunities as they come. If you're sitting there trying to repair your credit score, trying to get to 680 or above to get to conventional, and the prices drop, and typically these are small windows. They don't stay depressed for a whole long time. If the prices drop, I'd hate for you to stay on the sidelines because your credit score is still 620, or because you were just $40,000 priced out and you didn't know that if you went with that FHA loan, you could earn yourself an extra $40,000 in buying power. And so that's why in this very moment, it's important to talk about FHA loan, because this really could be the on ramp to taking advantage of lower real estate prices, and kind of a one time for a while opportunity for a lot of you to get into real estate, especially California real estate. And that's why we wanted to bring this information to you today. We're trying to keep you guys informed about what's going on in the market, the direction the market's going to go, and along with all the doom and gloom, provide you some information that can help you be prepared and take advantage of the opportunity. So, of course, to take advantage of this opportunity, you need to talk to your trusted professionals. So, Dave, looks like you have a point to make. Make
Yeah,
that,
just
and also talk people through what it would be like to call someone like you and start the process of getting pre-qualified for an FHA loan to be prepared.
Yep. All right. So first thing is I want to reiterate that, and again, the benefit of the FHA loan, especially if, we're talking about, is the timing right? Is the timing right for you? Maybe at this moment, the second, no, maybe it's a month, maybe it's 3 months, maybe it's 6 months. And people that have been sitting on the fence and been hoping that interest rates come down. Again, and I want to reiterate, the other benefit of an FHA loan is if you go a conventional loan, value comes down 20,000, maybe the value drops on your home, but you're in it for the long haul. Doesn't really affect you that much because you weren't going to sell anyway. Your payment's fixed. And we always talk about the benefit of having a fixed payment. Well, now you're in a position where if rates drop a half a point, whatever that looks like down the road in a conventional loan, without bringing in money, you cannot, or you're very limited in your ability to refinance. With an FHA loan, if that house dropped 20,000 bucks, but interest rates came down a half a point, 3/4 of a point, a full point, which in our scenario, that could be $350 a month. You can refinance that FHA loan without an appraisal, without having the value of equity in your home. So again, another
Gotcha.
key point there. So you're kind of locking in what you think is a favorable purchase price in a market, but your also hands are not tied to refinance down the road.
Gotcha. And if you're not totally tracking what Dave's saying there, in the conventional loan scenario, if values have dropped and you have to get a new appraisal on a refinance, they're only going to loan you. There's a loan to value cap. They're only going to loan you a certain percentage of the value. And if you've lost enough value that you drop below that, then that can limit or eliminate your ability to refinance that loan. And that risk is taken off the table when you utilize an FHA loan versus a conventional loan.
Yeah, well said. And the second point, part of your question was, what does it take to contact me to get pre-approved? Simple phone call, reach out to me, text, email, call. We set up some time. Usually we'll take initial call, 15 minutes, just an introduction call. If we're going to dig a little bit deeper and I ask all the pertinent questions, you have all the pertinent answers, then we really dig into, based on your timing, let's now start gathering some income documentation. So I ask you all the, questions, what's your timeline look like? What's your purchase price? How much are you comfortable with the mortgage payment? We kind of back into that. And again, are you talking to an agent? If you're working with Rich in Rich's area, if you say, well, I'm love to buy a house and I want to keep my payment under 1,500 bucks a month. Well, probably not realistic, right? Like,
Yeah.
in the areas, but depending on where you're looking to buy, we can back into what your payment comfort level is, and then really talk through your income scenario, your current income, what your future income looks like, your credit. If your credit's depressed a bit, why is that? We can uncover what are those reasons, talk about how soon we can do credit repair, the steps that you need to take. So it just becomes just a general conversation, some dialogue. And then once we check enough boxes, then I just take an application over the phone and get you underwritten with a property address to be determined. And that's good for as long as it takes. We maybe refresh that every 3 months. If you're out looking and you don't find something, or it takes 6 months to a year, as long as there's been no major significant changes in your profile, and no job loss, you didn't go buy a Mercedes with a $900 a month payment and didn't, that type of stuff. We've seen it. So
Yeah.
just throwing that out there. So
Yeah, exactly. So, like I said, if you're in our market, we'd love you to give us a shot. If you're not in our market, or if you're not giving us a shot, let's give you a quick couple criteria. And I've got whole videos on this on the channel. But whenever we talk about reaching out and getting pre-qualified, how do you pick someone to get pre-qualified for? Don't go with your uncle. Don't go with your brother. Don't go with your cousin. Go with someone who can do a really good job and understands. Here's the deal. In real estate, 75% of people fail in the first year. 87% of people are out of the business within the first 5 years. If you're working with someone who's been in the business less than 5 years, they probably won't be in the business for the long haul, which means they don't have the skills to help you. And they're not real worried about, pleasing their clients or client retention, because they're probably already on their way out. So number one criteria for me, when I'm, helping family pick someone in another state, which is a service we can provide for you as well, and interview people on your behalf. You can reach out if you want that. But the first step is, have they been in the business 10 years or longer? I don't talk to anybody who hasn't been in the business 10 years or longer. Okay. And the second step is the easiest one. It's how they answer your first question. So if you're talking to a realtor or a lender, ask them, is now a good time to buy? Or if you're seller, is now a good time to sell? But we're talking to buyers. How they answer that question tells you everything you need to know. If the answer is yes, then hang up and call somebody else, right? They should ask you some other questions. My response to that question, and Dave's as well, is, I don't know yet. Let me get some information. Let's decide if it's the right time for you to buy. How long are you going to stay in the house you're going to buy? How much money do you have down? Are you selling another house? Why are you moving? What are your goals with this real estate? Are you looking for a family home to be the hub of your life for the next decade? Or are you looking to flip this thing and try to make some quick money, right? Have you owned a home before? Do you know what you're getting yourself into? There's so much that goes into whether now is the right time for you to buy. That's why we always say on this channel, there's no blanket real estate advice that's good advice. So those are two simple criteria. Have they been in the business for 10 years or more? And do they answer you with a salesy, self-serving, yes, now's a great time to buy or sell. Let's go out and get in the car? Or do they ask you some more questions first and try to figure out what's best for you and your family? The two easiest criteria to pick somebody to work with in the marketplace. All right. So, and again, we have whole episodes on the channel if you want to dig deeper into that. The ultimate goal here is to let you guys know, if you have not yet considered an FHA loan, it brings a lot of benefits to the table. Contact your local lender or Dave and dig into this and see if it will provide a quicker, sooner, or more advantageous on-ramp into home ownership for you to take advantage of the buying opportunities that are going to be available to you late this year. We're at 32 minutes. You have listened to us for quite some time. We really appreciate your time. As always, thanks for making it to the end with us. I'm Rich Curtis.
And I'm Dave Miller. Thanks, Rich.
Have a great day, everyone.